Generally speaking, I'm very bullish on REITs. They are today priced at some of the lowest valuations in years after dropping by 30% in 2022 due to fears of rising interest rates. But what the market appears to have overlooked here is that REIT balance sheets are the strongest they've ever been, with average loan to values of around 35% and very long debt maturities of around 8 years. Moreover, it's important to remember that interest rates surged largely because of the high inflation, and this high inflation led to some of the fastest rent growth in years. And so this explains why REIT cash flows have been growing rapidly and hit new all-time highs last year. So I'm very bullish. I'm buying a lot of REITs, but this does not mean that I'm bullish on every REIT. On the contrary, most REITs don't pass our selection process, and there are quite a few that I would sell today. Which one are they? Hey everyone, this is Jussi. I run an investment firm that specializes in REIT investing, and in today's video I'm gonna talk to you about 3 very popular REITs that I would sell today. Make sure to stick till the very end because the third REIT in particular is very popular and you don't want to miss that one. And before I get into it, if you could still like the video, that will help me a lot. Thank you very much. So the first REIT I want to talk to you about is a REIT called Iron Mountain. Ticker symbol is IRM. A few years back, this used to be a battleground REIT, with the bears arguing that its paper storage business would face a secular decline, and then the bulls arguing that its data center business will make up for it. Lately, the market has really focused on the data center side of its business, and as a result, its valuation has expanded very significantly. But here's the issue. The vast majority of the revenue is still coming from the paper storage today. And while I don't expect paper storage to go anywhere anytime soon, I'm sure you would agree with me that this isn't exactly a growth sector. It's a mature business that's generating consistent cash flow today, but over time what I fear is that the growth is going to turn negative, and even if you get very slight negative growth of, let's say, negative 1 to 2% same property NOI growth, I fear that this could have a very significant and negative impact on the market sentiment of the stock, because the market is a forward-looking machine and it's quick to extrapolate recent trends far into the future. This explains why the company is today priced at the high valuation, because lately the company has been performing really well. But if now we see the organic growth turn even slightly negative, I think that you're gonna see the opposite effect and the market is quickly gonna punish the stock of the company. If the stock was discounted, I would be interested, but today, compared to the rest of the REIT market, it's actually quite expensive, especially given its risk profile and its growth prospect. For this reason, if I owned Iron Mountain, I'll probably look to sell today. Then the second REIT I want to talk about is called Public Storage, ticker symbol PSA. This is the largest self-storage REIT. It's a blue chip company, excellent management team. I got to actually meet them recently at the City Global Property Conference. I sat on a round table with them. Really, I don't have much negative to say about the company itself. Again, great management team, great balance sheet, great assets. But the issue here is not the company, it's the sector itself. I fear that self-storage has been overbuilt in the US. It's a sector that benefited very significantly from the pandemic because a lot of people were moving around from a place to another. A lot of the older generations passed away and left a lot of stuff behind that needed to be stored. And then on top of that, it also enjoyed a lot of growth in demand from the work from home trend, because suddenly people wanted to have a home office, and so they needed to make space for it, and all the extra stuff then was stored at the self-storage facility. But now things are slowly moving back to normal. This led to a surge in new supply of self-storage. Suddenly every developer started building new facilities, especially also because interest rates were very low over the past years. But the issue is that now things are starting to return to normal. People are slowly getting back to the office at least part of the time, and so a home office is not as needed anymore. Then on top of that, people also aren't moving exactly as much anymore, and so I fear that suddenly we're gonna end up in a situation where the supply is gonna exceed the demand, and with that, the large rent hikes of the past years may not prove to be permanent. I fear that a portion of the gains of the past years will prove to be only temporary, and so in a similar way as the tech companies benefited greatly from the pandemic and then saw some consolidation in their growth, I think we're gonna see the same thing with the self-storage sector. And despite that, public storage is still priced today, despite its recent dip, at a reasonable valuation. I wouldn't say that it's very significantly overpriced or anything. I think the valuation is reasonable, but at the same time today you have a lot of REITs that are deeply discounted, and for this reason reason I'm not interested in this REIT, I will probably sell it to buy something else instead. And then finally, the third REIT, this is probably the most popular of these three, is called Tanger Factory Outlet, ticker symbol SQT. Again, I got to meet this REIT along with 20 others at the city conference recently. By the way, make sure to subscribe to this channel because I plan to make a lot of content on these meetings with management teams in the near future. You don't want to miss it out. But yeah, so this REIT is very popular because it's based on steadily rising balance sheet, has a great track record, a good balance sheet, a great management team. But the issue that I'm having with it is that it's mainly invested in outlet centers. And I fear that this retail format is gonna be the worst positioned in the day and age of e-commerce. To understand why, you need to consider two things. First of all, the locations of outlet centers are typically a bit outside of the city. They're a bit more remote. Typically, you'll drive half an hour to go to your outlet. And so far, consumers were fine to drive because they expected to get better prices at outlet centers. But now suddenly they can get the same or better prices online with free same-day shipping and free returns as well. And so the 30-hour drive suddenly is getting a lot longer. And then on top of that, you also have TJ Maxx and other discount retailers now building stores in more convenient locations nationwide. And so this new competition is really going to impact outlet centers very heavily because they compete mostly on prices. I think that Amazon and other e-commerce websites and then TJ Maxx for physical retailing offer similar prices but with more convenience, and so this is a big issue for outlet centers. And then the second problem of outlet centers is that their layouts are very unique and difficult to adapt to this changing retail environment. It's if you look at an outlet center from the sky, I'll put a few pics, it's a very large facility, typically on one floor. It's really well suited for fashion and other accessories retailing, but it's difficult to put services or restaurants or anything experiential in there. It's not impossible, but it's much harder to put that in there than in a Class A mall in an urban environment, as an example. And so I think that they're going to suffer, and they're going to have a hard time to adapt. Unlike Class A malls, which have also been suffering, but they've been adapting and rapidly diversifying their uses to be more resilient in this evolving world. Despite that, Tanger is today actually priced at a comparable valuation to that of Simon Property Group, which is the biggest Class A mall REIT. Simon has a better balance sheet, has better assets, better growth prospects in my opinion. And so here you need to ask yourself, why would you own Tanger when you could buy shares of Simon at comparable valuations? And so these are three popular REITs that I would sell today. Now, if you want to learn more about what REITs I'm buying, feel free to click the link that I'll put on the screen. It will redirect you to another video that will highlight some of my favorite opportunities. And then if you want to have access to my entire REIT portfolio, feel free to join my REIT newsletter also for a 2-week free trial. I'll put a link in the description. And again, if you can like and subscribe, it will help me a lot. Thank you. See you at my next one. Bye-bye.